basically 50 straight years of deficits, again, to slightly oversimplify. That never would have been allowed to occur because the U.S. would have had to sell dollars to buy Bancor to settle those deficits each year. And we would have weakened the dollar through the Bancor against our competing currencies, against our trade partners, and we would have gotten more competitive. And so you would have had two things. It would have driven a greater real-time balancing between consumption and production here in the U.S. Obviously, we've basically offshored a lot of our production over the last 50 years and focused on consumption and really focused on U.S. government consumption in particular. So that would have forced greater fiscal discipline on the U.S. government. It would have kept a lot of these middle and working class jobs that offshored elsewhere over the last 50 years. That would have kept them here. That would have led to less wealth inequality. It would have led to probably lower corporate profits, all else equal, greater income and wealth equality, and probably a lot lower political tension in the U.S. if we had gone with this Bancor system. The competing system was the Harry Dexter White system, which was the dollar is the center of the system. All of the currencies are tied to the dollar, and the dollar is tied to gold at $35 an ounce. And that was the system we went with out of realpolitik, for lack of a better reason, which is to say we had most of the men, we had almost all the industrial production, we were the world's biggest oil producer, we had all the gold, and so what we said went. And that system worked for about 25 years, but once the rest of the world was back on their feet, they were very productive. We also did some things to run deficits on purpose to help get them the dollars to get them back on their feet early in the days after World War II. But by the late 50s or so, Germany, Japan, in particular, other parts of Europe to a lesser extent, they're inherently very productive economies, and they started running bigger and bigger trade surpluses against the U.S. U.S. kept running trade deficits, and then we made some policy choices, both from a foreign standpoint in terms of the war in Vietnam, and domestically with Lyndon Johnson's Guns and Butter, or Great Society, I should say, or what they called Guns and Butter. So we're running these big deficits, and the peg to the dollar of gold at $35 an ounce began to be called into question because it's pretty simple math. You can look around and the Americans have all these dollar debts outstanding sitting in foreign exchange reserves with our trading partners after deficits we'd run from, call it 1947 or 8 through 1970, and they knew the pile of gold we had, and they can do this pretty simple math to say pile of gold times $35 and compare that number to the debt we have outstanding, and it wasn't close to being the same number. The debts outstanding were, I want to say, like 4 times the size by the time 70 or 71 rolled around. So it was obvious that we weren't going to be able to maintain the deal. So either we were going to devalue the dollar against gold so that we could redeem these debts in gold, or as it turns out, we went another direction, which was to simply unilaterally close the gold window. It was supposed to be temporary. That then led to this system where no one knew what the dollar was worth. We then basically get into an arrangement with the Saudis to price their oil only in dollars. And that came to be a key hallmark, I guess, of a system that came to be known as the petrodollar system, where basically dollar surpluses in oil were recycled back into eurodollar markets, financial markets. It led to a supersizing of the U.S. financial system, U.S. financial assets. It led to a hollowing out of the U.S. industrial base, of the U.S. middle and working classes, as basically the U.S.'s biggest exports became dollars and treasury bonds. And we had to export dollars and treasury bonds. We had to run deficits to export dollars and treasury bonds to our trade partners. And that led to this 50 straight years of deficits, basically unbroken, that I referenced before. And so those were the two systems. That's how it has evolved. That is how energy is a key linchpin within that. The other key linchpin to the petrodollar system is that the dollar was effectively kept as good as gold for oil from 1973 through, call it 2003. So nearly 30 years, because if you look back historically, the price of oil in gold is remarkably consistent, consistent at 10 to 30 barrels of oil per ounce of gold for centuries, certainly decades, but more like centuries. For 30 years, the dollar was effectively kept as good as gold for oil, where we saw oil trade between $15 and $30 a barrel for nearly 30 years, by and large. And a big part of that was the U.S. monetary policy. We were the biggest consumer of oil. We were the biggest importer of oil. And so when we slowed our economy, when oil would get near $30 a barrel, the Fed would hike, U.S. economy would slow. When it was near 15, U.S. Fed would cut, U.S. economy would increase. There was this period of time where basically oil was kept as good as gold for oil. Excuse me, the dollar was kept as good as gold for oil. So we broke the sever to gold, but in the end, because we were managing the dollar to be as good as gold for oil, people were kind of like, well, it's not quite the same, but ultimately we don't need gold, we need oil. And as long as the dollar holds its value relative to oil, okay, we'll do that system. 2005, 2006, you came to a critical moment where U.S. is quickly becoming not the biggest importer of oil anymore. China is. What oil was saying the U.S. needed to do was raise rates significantly. What the domestic U.S. economy was saying the Fed needed to do was to cut rates drastically because the housing bubble was popping. It came to a head in 2007. You started having big problems in the mortgage market. The Fed faced a choice: either hike because oil was at 70 and going higher, or cut because the housing market and the banks were increasingly in trouble, and they cut. They cut rates. Oil went from 70 to 150 in 9 months. The United States will not manage the value of the dollar relative to energy prices, in particular, commodity prices more broadly. That fundamental tension between the Americans managing the dollar as a domestic economy issue versus a global utility issue, a global reserve currency, that has led to some tensions to start moving the system over the last 15 years in a direction towards change.
Yeah, I think that tension between what the Federal Reserve is doing and whether or not they're managing interest rates for the benefit domestically of U.S. citizens versus for the benefit of the world, right, as the issuer of the global reserve currency, is a fundamental one. And honestly, the reason I love talking to you about this is you were kind of the one that showed me, the way that I kind of think about this is the one thing that every country needs is energy. It's the most important raw material input for basically every economy in the world. So what you don't want is an asset liability mismatch, where if you have an economy, it needs X amount of dollars in oil, which is basically your liability. You want your asset, which is your money supply, to be relatively constant to your liability. So that's why you had that relationship between gold and oil. And I think what we tried to do, right, if I'm understanding you correctly, is we tried to replicate with that the dollar. We said to everyone in the world, this dollar is basically going to roughly buy you the same amount of oil. Where you went back to the 1970s, you said, was Volcker really doing it to raising interest rates to stamp out inflation, or was he honoring that, that implicit promise to the rest of the world that we were going to keep as good as a dollar for gold for oil, basically? And we basically broke that promise in 2008. I agree with your thoughts entirely on the breaking of the foreign exchange window, right? That we did with Russia when we confiscated their central bank assets. So what are the ramifications of us essentially breaking this social contract with the rest of the world?
What we're talking about really, when you say good as gold for oil, keeping the dollar good as gold for oil, is keeping the dollar neutral to positive in real rate terms relative to oil, right? So if oil prices go up 5% per year, you better keep rates at 5% minimum. 5% rates with US debt to GDP at these levels, it simply can't happen. The U.S. cannot afford to pay positive real rates relative to price growth of energy needed to drive new supply. And the producers of energy and the creditors to the U.S. that import energy cannot afford to not get paid a positive real rate on their savings. When you've had these types of tensions historically, you get war. And one side goes and kills all the others, and whoever's left says, here's how it's going to go.